Welcome back to Street Smart. I'm Carol Massar in a finally sunny Palm Beach. Now, you've heard the term underwater mortgage. That is when the mortgage is actually bigger than the value of the house. We've talked about it a lot over the last year or so. My next guest says a bunch of hedge funds are actually making a killing buying those underwater mortgages. He's Pat O'Keefe. He's the founder of O'Keefe Associates, what he describes as a transactional financial consulting group. So let me ask you, Pat, about 40% of those transactions are real estate related. Let me ask you, though, if the mortgage is underwater, I mean, I think some people at home are saying, you know, where's the real value?
Well, the hedge funds are typically buying these at fair market value of the underlying asset. So they're buying with the eye to the future and buying at deep discounts even from today's value because there's not a lot of capital chasing these types of transactions.
So even though they're distressed, they're getting at them at very distressed prices.
Absolutely.
And so down the road, they have the potential to make what kind of returns in your view?
On average, they've been making 25 to 30% on these types of returns. And quite frankly, I mean, it's a great opportunity for them, but it's also suppressing capital availability in other industries outside of real estate.
Such as?
Automotive would be a great one. You know, being from the Detroit area, there's not a lot of capital today chasing auto suppliers, and that'll continue to be a problem.
I mean, that's a good point. I mean, financing capital out there is scarce to begin with still, correct?
Absolutely.
All right. So then so the concern is if it's all going here to these underwater mortgages, I mean, again, it's not going to some other sorely needed areas.
Right. And arguably, I mean, we've only had the tip of the iceberg. I mean, we still have a lot of banks that are under FDIC watch that could fail, which means they've got typically they're smaller banks which might have 70 to 80% of their loans in real estate mortgages. So there could be a continued onslaught of opportunities in this market.
That's interesting. So what's the more significant concern then? I mean, are there other industries that have the potential of a lot of companies, businesses going out of business because of that?
Well, as the economy kickstarts here, there's not going to be capital available for expansion, so that's clearly one.
Right.
I mean, a lot of these companies have been holding on by their fingernails and really haven't had a chance to recover. And it's clearly impacted the space for capital.
Let's go back to the mortgages and these distressed mortgages. I mean, it's kind of a little bit of a vicious cycle here, isn't it? It continues. We're not over it yet.
No, it's really a downward spiral, and part of it I blame on the mark-to-market rules. We're looking at long-term assets and trying to value them today, and albeit a very unstable market, which is depressing those values. And there's precedent for it to be handled over a longer period of time. They do it with pension fund assets. We don't look and adjust pension fund contributions every time the market falls 20 points in a year. You know, we take a longer view and smooth it.
All right. Let me just also ask you, because you've also said that the FDIC is weighing on housing prices by selling off mortgages for banks that it took over that. Just quickly, I mean, how is that?
Well, the FDIC, the first thing they do is they write a check to somebody to take over the depositor liability. Their recovery action then is from the loans that are held by the failed financial institution.
Right.
And those are typically real estate mortgages. They blow those oftentimes in pools, or they put them on the internet exchanges, and that is depressing the same market that the banks are trying to sell off their distressed assets.
It's kind of a crazy cycle again.
It's just a downward spiral that just keeps repeating itself.
All right, we got to run. Pat, thank you so much. Patrick O'Keefe, everybody.